This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Audit planning. Audit planning is an immensely important topic for this paper. There's nearly always a question which in some way brings in audit planning and asks you to respond to it or to maybe carrying out some of the planning steps. You should know the purposes of audit planning, but of course in this paper you're going to be brought in at a slightly higher level. You might be more involved with the planning rather than simply describing what planning is for. However, why do we plan? Well, it is to carry out the audit work in an effective manner. So effective manner, I suppose, ultimately means giving the proper audit report, carrying out work which gives reasonable assurance that the financial statements are free of material misstatement, and that avoids the calamity of audit risk, where you say the financial statements are true and fair, but in fact there's a large misstatement within them. Planning, it will kind of look at the overall strategy, which could be, in a well-organized company, are we going to pretty much rely on internal control and only do a little bit of substantive testing? Or have we decided that the company is a mess, a shambles, no good internal control, and really our overall strategy is going to have to go in and do an awful lot of substantive testing. And from this overall strategy, then you get into a detailed approach. And it does get down to, when are we going to be doing it? Who's going to be doing it? Are we going to involve external experts and internal audit and so on? However, for this paper, particularly, it's probably these two areas that we need to be looking at. Appropriate attention to important areas and to identify potential problems, because in response to our findings here, we're going to alter the type of work we do and the amount of work we do. We need to find perhaps additional evidence to support some of these areas. So appropriate attention to important areas, really, we're nearly looking here at materiality. This chapter goes on and looks at materiality in a couple of slides, but nearly always an important area, another word for it is a material error, often because of its size, but sometimes because of its nature. But as I say, we'll see more to do with materiality, and it makes sense that if an item is material, if it is, for example, very large, then you will almost certainly do more audit work. You want to be more careful about the evidence, more certain about the evidence you get, which supports this very large figure in the financial statements, and you won't need to do nearly as much work in a very small, very trivial figure. So, very crudely, the bigger the figure, the more evidence we need to support it. It's not quite as simple as that, but roughly speaking, that's where we're going. Identify potential problems. And typically the way a question will be presented to you, there's maybe notes of a discussion that maybe the partner has had with the finance director of the client. All of these things are kind of noted down. And you have to, from these notes, identify maybe specific problems which will have an effect on the audit. Maybe say what the effect on the audit is. Maybe say how you're going to respond to these particular problems. For example, you could be told that halfway through the year the company changed its accounting system, changed from one IT system to another. Well, the potential problems are there that you almost have got two audits. If you change your accounting system at the end of June, we have to audit what happened under the old accounting system up to the end of June. Are those transactions okay? Are the controls over the accounting system operating? Then you have to look at the transition itself. Did we take the closing balances in one system and successfully migrate them to the new system? And then you have to look at what happened in the second part of the year, and particularly maybe the first couple of months, where people were learning about the new system and more prone to make errors. And we have to make sure that for the second half of the year, the accounting system worked properly. And those are potential error problems. Another potential problem is maybe the finance director has left, and the finance director is not going to be there to prepare the financial statements. So maybe we've had the accounting department as a kind of ship without a captain for a couple of months, and we need to know how we're going to respond to this kind of accounting department, which is maybe not been enjoying the proper supervision, and in particular financial statements are not going to be prepared with this experienced person overseeing the preparation of those documents. We need the work to be completed expeditiously. Expeditiously means pretty quickly, and also kind of efficiently as well. We certainly want the work to be ready for the client and the client's AGM and so on, whatever that's going to be. So you're going to be working back in the planning. Here's when we need the financial statements to be approved. Here's when we'll sign the audit report. Here's where we'll do the final audit. Here's where we'll do the interim audit, and so on. If you don't make these plans, you will not be able to hit those deadlines. We've talked about proper staffing and work assignment when we looked at quality. Here, proper staffing, work assignment, we've talked in here, also facilitating review. We have to build into the planning process both the time and the mechanisms for the reviews to take place, and also to leave time that if the review says we need more work done there, that there's still time to send people back to get additional audit evidence, and this can all be done before the financial statements need to be approved. And sometimes we need to coordinate with other parties. Maybe it's internal audit. Maybe we need to get a certificate from the company's actuaries stating something about the amount of funds in the pensions of the employees. Maybe we have to get a specialist valuer in some situations. And all of this needs to be kind of properly coordinated. We also need to gain an understanding of the entity, and ISA 315 states these 8 or so specific elements which feed into understanding the entity. So as a nature of the entity, think of that as broadly, what does it do? Think of it as maybe who owns it. Is it a listed company? Is it privately owned? Is it a subsidiary of another company, and so on? It's going to be quite difficult to plan an audit unless we know that. What sort of industry is it in, and what are the regulators like in that industry? We might well be required to produce some sort of special report or specially worded audit report for certain industries. What are their accounting policies? Are we happy with their accounting policies? Do they want to change their accounting policies this year? What are their objectives and strategies? It is, of course, the director's responsibility to be looking at the strategy of the organisation, a kind of long-term future of the organisation. Objectives are a little bit kind of shorter. But if we're going to be doing a reasonable audit, we need to know, for example, very simply, that it is an objective of theirs to be profit earning. Because we could be auditing a charity where the objective is not to be profit earning. The objective is to do good works, to support the objects of the charity. We need to know something about the internal control and the control environment. The control environment is like at the top of the organisation, almost a culture of control. It's this tone from the top, here being set within the client, taking internal control really seriously, and then the internal control system. If we conclude that they have what looks like a good internal control system, then of course this is going to alter our planning of the audit. We're going to rely much more on the internal control system, particularly if there's a very good control environment where management is very kind of strict and really values the good internal control system. How does the entity identify business risk? So business risk is where something goes wrong in a business, like maybe going into the production of a product which isn't popular, or maybe it is selling goods to someone who isn't going to pay, or maybe is it exposing employees or customers to some sort of industrial type of risk. We'll see shortly, and it's been mentioned I think towards the beginning of the lectures, that it's not the auditor's job to look after or control business risk, but very often where there's a business risk there is a knock-on audit risk, and we have to know how the company identifies these business risks, because this will give us some insight maybe into where problems in the audit are going to be encountered. And how do they measure financial performance? Are they interested in profit? Are they interested in hitting their budget? If they're interested and put a lot of store in hitting their budget, then of course this might induce them into manipulating sometimes the financial results so that they are seen to be hitting their budget. Perhaps they're not interested in financial performance, or many non-profit seeking organizations, as long as they stay within the budget, they're more interested really in measuring how effective their operations are in some other way. Now, materiality, again, immensely important in this paper. Question after question after question, we'll start off with this sort of information, or have that sort of information somewhere in the information given to you. It won't tell you what the percentages are, but it will tell you the revenue, it will tell you the total assets, and will tell you the profit before tax. And the only reason they tell you the revenue, the assets, the profit before tax, is so that you can apply these percentages. Because these percentages are recognized by the examiner as, well, wider than the examiner, but certainly for the purposes of the exam, these are recognized as indicators of where something becomes material. So if you had an asset which was only representing, say, 0.5% of total assets, then it's unlikely to be material. It's not guaranteed to be material, but it's unlikely to be material. And you're not going to create too much fuss maybe about that. Or if there's an error, a misstatement, which is less than the levels of materiality, then this may mean that you don't have to alter the audit report. But once you arrive into the land of materiality, then you have to look at these figures more closely, you have to look at the misstatements more closely. Now, strictly, materiality is where an omission or a misstatement could reasonably influence the economic decisions of a user of financial statements, really meaning a shareholder. Now, this is a matter of judgment, and it's a matter of the judgment of the engagement partner whether some omission or misstatement could reasonably influence economic decisions of decision makers. And of course, about economic decisions of users. And of course, different users might look at the same error differently. One user might be, by seeing a particular profit, might be induced to buying more shares, whilst another user seeing that profit might not buy more shares. So we don't know how users are actually going to react to figures, and it's a matter of immense judgment of the partner. However, that's no good to people carrying on the audit. They need guidance, they need direction, and the sort of cut-off points which are kind of used are these percentages here. It's not just the size and nature of misstatement. I think we've said before that you could have a misstatement which is relatively small, but if it relates to a figure that you would expect to get exactly right, you're going to be very intolerant of misstatements. So there's no real reason why you shouldn't get cash at the bank correct to the last cent. Why would you allow any sort of misstatement, no matter how small? It just looks sloppy to get cash wrong, even by a few cents. It should be capable of getting it precisely right. What we need to look at is the nature, value, and impact of these misstatements. Performance materiality. What we have to look at ultimately is the materiality for the financial statements as a whole. So we could be kind of saying, well, we're going to be looking at, let's say, 1% of revenue. If something's over 1% of revenue, it's probably material for the financial statements as a whole. But the trouble is that you could have a number of relatively small errors in expenses, relatively small errors in revenue, and if all these errors go to understate costs and to overstate revenue, all of those errors are going to stack up and they're going to overstate profit. So what is normal is to set what's called performance materiality, where you bring the materiality level down lower than those percentages. And it's called performance materiality because really it's used by the members of staff who are performing the audit. The people out at the clients, the 4 assistants and the supervisor, whatever it is, they will be given this lower figure for materiality, and this is what they're going to be noting down. And then this can all be shown to the engagement partner at some point, who can look at the, if you like, sum total of these misstatements and decide whether or not, although individually they're all fairly small, whether or not it adds up really to an effect which is regarded as material. You can have percentages in there. If something is a very sensitive figure, something that's somebody's going to look at particularly sensitively, like maybe director's remuneration, something of that sort, then you can set a much lower, much less tolerant performance materiality. If it's something like depreciation, there's obviously a lot of kind of views on depreciation. Nobody much cares really whether you depreciate your cars over 4 years or 5 years. Then you're not going to be quite as excited about something, a small error in something where there's going to be differences of opinions anyway.